Hello everyone, a very warm welcome to my channel. In today's video, we are going to talk about a very simple concept, but a very important one, which is inventory turnover ratio. If you're new to the channel, please hit the subscribe button and hit the bell icon, and you can follow me on different social media channels as well. Let's get started. So inventory turnover ratio is a measure of how efficiently is the inventory or the stock being managed by the company. Inventory management is often not discussed so frequently, but it is still a very important function of running a business, or it's an important criteria for analyzing a company or a stock. Inventory management covers the entire business cycle, right from the purchase of raw material, production, inventory management, storage, and supply of finished goods. The entire cycle comes under the concept of inventory management. And if at all a company is efficiently doing this, they can save a lot of money for their shareholders. On the contrary, if inventory management is not being done properly, you can make out from the financials any future mishappening in the company, like from the inventory and accounts receivable. You will get some signals if at all something is going to go wrong in the company. Likewise for the cash flow also. Certain things like just-in-time concept, wherein you maintain optimum inventory and you procure it at exactly similar times when it gets over. So these kinds of concepts help the companies to manage inventories efficiently and keep the inventory turnover ratio high. The different strategies for maintaining inventory efficiently differ from company to company, differ from industries to industries. Like for trading companies, it is different. For manufacturing, it is different. Likewise, for auto sector company, it is different. For a pharma sector company, it's different. So this is a case-to-case specific thing, but still it is a very important criteria for checking the efficiency of the company and the management. For a manufacturing concern, the amount of time it takes to manufacture a product decides how much inventory the company has to keep in stock. Suppose the company is taking about 3 months to manufacture a particular product. So for the next batch to get manufactured, it will take another 3 months. So they have to keep in stock inventory worth of 3 months. So this increases the working capital requirement of the company. So for manufacturing concerns, how efficiently they manage the manufacturing process and cut down their manufacturing time decides how much working capital is involved in their business. During the fundamental analysis also, a lot of times we don't look at the inventory turnover ratio, but it is important for a fundamental analysis point of view also. Now let's understand how it is calculated. The formula for calculating inventory turnover ratio is operating revenue divided by the average inventory for the year. What is average inventory? The opening inventory at the beginning of the year, the closing stock at the close of the year, the sum of both of these and divide by 2. So this average inventory figure should be used to divide the operating revenue to find out the inventory turnover ratio. What does inventory turnover ratio signify? It signifies how many times the company is able to rotate the stock in a given year. Some people consider using cost of goods sold or cost of raw material instead of revenue. Some people use closing inventory instead of the average inventory. So it differs. People, depending on their comfort and their interest, they modify the formula a little, but on a generalized basis, this is the formula to calculate. Another step ahead concept in the same thing is inventory days. Our inventory days calculated 365 divided by the inventory turnover ratio will give you inventory days. Now what will inventory days signify? It signifies that at any given time, the company has to maintain stock worth of how many days. So this is signified by the inventory days. Now let's further understand how it is interpreted. High inventory turnover ratio means lower inventory turnover days, as we are using the inventory turnover ratio in the denominator while calculating inventory days. And the higher inventory turnover ratio means lower working capital, because you are able to rotate the stock faster in a given year. That means you need lesser working capital. Similarly, it is vice versa. If the inventory turnover ratio is less, inventory days are more, and you require more working capital for the business. So the higher the inventory turnover ratio, the better. Two ways of analyzing the inventory turnover ratio on a comparative basis is, for the same company, you can compare the inventory turnover ratio for a number of years and see whether the efficiencies are increasing or decreasing. Another way is you can compare the inventory turnover ratio of different companies in the same sector and see whether the stock which you are analyzing is having the higher inventory turnover ratio compared to its other peers in the same industry or not. Now let's discuss some examples. The first example is for Hester Biosciences. In Hester Biosciences, we are taking an example of financial year 20. Opening inventory was about 48.5 crores, closing about 60.43 crores. Average inventory was coming to about 54 crores. Turnover for that year was about 154 crores. So if you divide 154 by 54, you get an ITR of about 2.8 and inventory days of about 130. Now, what does this signify? 2.8 ITR signifies that the inventory turnover ratio is very less. The company is taking a lot of time to sell their inventory or manufacture their inventory. And that is why the inventory turnover days are 130. So at any given time, the company has to keep the stock for about 130 days in their godown. Coming to the next example of Kaveri Seeds, opening inventory was about 600 crores, closing about 722. Average was about 663. Turnover is about 883 crores, so the ITR comes to just 1.3. And inventory days are as high as 280 days. So this shows that the company's inventory is not even moving 2 times in a given year, and the company has to keep a stock of about 280 days anytime in the warehouse. Coming to HUL in the third example, opening inventory was about 2636 crores, closing about 3383. Average comes to about 3000 crores. Turnover was about 45,000 crores. So ITR comes to 15 times. So this means that the stock is moving very fast. They are able to rotate the inventory 15 times in a given year, and the inventory days are just 24. So this is how the efficiency is high. Coming to another example of Supreme Industries, opening inventory and closing are about 890 to 760 and average is about 825. Turnover is about 6,300 crores. So ITR comes to about 7.7. So in this also, if you see, the inventory management is efficient and inventory days are just 47. So coming to the next example, in this we are trying to compare the inventory turnover ratio of a same company over a period of years. If you see for Deepak Nitrite, in FY18 it was about 5, FY19 about 6.5, FY20 about 10.7 and FY21 about 11.3. So what do you observe in this? You observe that over a period of years, of 4 years, the inventory turnover ratio has continuously risen from about 5 to 11. So this shows that the company is getting more and more efficient in managing their inventory. Coming to the next example of Graphite India, in FY18 it was 4, FY19 about 3.6, FY20 about 1.98. So this shows that there are inefficiencies in managing inventory and the company is required to maintain more stock at a given time and they need more working capital. So this also impacts the profitability of the business, the earning per share, as well as eventually the price of the share also. Coming to the next and the last example, in this we are comparing the different companies in a single sector, which is the cement sector. Ultratech's ITR is about 11.13, Shree Cement is 7.5, ACC is 15.3, Ambuja Cement is 14.87, and JK Lakshmi Cement is about 9.08. So being in the same sector, manufacturing the same product, using similar manufacturing plants and processes also, you see there is a huge variation in the inventory management. In the same sector, there are companies which are having ITR as low as 7 and as high as 15, which is almost 2 times. So this shows that ACC is managing their inventory very efficiently and much better than Shree Cement. So this is about inventory turnover ratio. To just summarize, inventory management has a significant impact, as you have seen from the examples, on the business and the earnings of a company. It decides how efficiently the management is managing the inventory in the company. And in inventory turnover, you can see on a standalone basis, you can compare the same company over a period of years and also compare with other companies in the same sector. And from a fundamental analysis perspective also, ITR should be evaluated in all the cases where you do analysis. So thank you for watching this video. I hope you like it. If you like the video, hit the like button, subscribe it, and do follow me on different social media channels and where. Thank you for watching and have a wonderful day.